Namaskar dosto. Welcome back to the Stock Info. Today we are going to discuss about the intrinsic value in our episode 22. Infosys crashed yesterday. Did the value change or just the price? How to calculate the intrinsic value using the discounted cash flow on screener.in. Now, section number 1, the price versus value. Yesterday, Infosys fell sharply, Tech Mahindra fell and TCS fell. The Sensex had gained for 5 straight sessions, touching 77,410. Then a single trading session, it dropped 6.8%. Why? Accenture, an American IT company, cut its revenue growth forecast overnight. Indian IT stocks crashed in sympathy within minutes of the market opening. Now here is the real question. Did Infosys as a business change overnight? Did client contracts disappear? Did its employees vanish? Did its ability to generate cash for the next 10 years change in 12 hours? No. The price moved instantly on the sentiment and a single overnight headline from the different company in a different country. But the underlying value of the business, its ability to generate cash for the years to come, that does not change in one session. This is the single most important distinction in all of investing, price and value. Today I show you how to calculate the second one for any company yourself for free in live on screener.in. Section number 2. What is an intrinsic value? This concept changes how viewers see every stock forever. Every business exists to generate cash for its owners. Intrinsic value is a present value for every rupee of the cash that business will generate for the rest of its life. No next quarter, not next year, for the entire remaining life. This is the fundamentally different from the price. Price is what the market is willing to pay today. It moves with sentiments, with FIS flows, with single overnight headline. Value is what the business is actually worth, calculated from its cash generating ability over the many years. Many legendary investors describe this difference simply. What you pay is not always what you get. When price is below value, you have a margin of safety. When price is above the value, you are paying a premium for hope. Discounted cash flow is the tool that calculates the value. It converts future cash, which is uncertain, into a single number you can compare against the current price today. Now, in the section 3, the DCF formula simplified. Break the formula into 5 plain steps. No finance degree is required. Here is the DCF formula simplified for a retail investors. No finance degree needed. Step number 1. Take a free cash flow you learned in short 40. The cash left after capex. Step number 2. Project how free cash flow will grow for the next 10 years using the reasonable growth rate based on history. Step number 3. Discount every future years back to today's using discount rate for India 11 to 13% is commonly used, reflecting the cost of equity capital. Step number 4. Add the terminal value representing all the cash flows beyond year 10, also discounted cash back today. Step 5. Add everything together, then divide it by total number of shares outstanding. These steps I have shown in my next video shortly. The result is intrinsic value per share. Compare that number to the current market price. If the market price is below the intrinsic value, the stock may be undervalued. If the market is above the intrinsic value, stock may be overvalued. Now, coming up, a live demonstration. Open screener.in right now and calculate the intrinsic value of any company in under 3 minutes. This is the exact tool that converts the formula into a number you can actually use. Live screen demonstration of discounted cash flow demonstration. In screener.in. Go to screener.in, open the screener.in desktop here like this. Then go to search company. Whatever company you have, type here. You want to see the company. For example, I'll try for TCS here. When you click TCS, the details of TCS has come here. And now click on the cash flow section. On the cash flow section, you see that the cash flow for March 2026 is 52,094 rupees. This you have to remember it. Now based on this only we will calculate, we will make all the calculation as per this. So remember this figure always. Now we shall go to screener.in and calculate all the things. Okay. We have come to the Excel window now. Here, based on this, now we will do the intrinsic value of the stock. From the cash flow section, we have seen that the 52,094 is the amount, and this one the shares outstanding, the TCS is 361.81 crores. Current market price is 2,125 per share. Now for simple screener style demo, we have to assume following things. Growth rate should be 10% and discount rate should be 12%. We have assumed terminal growth rate is 4% and period of forecast is 5 years. Now we shall calculation of projected future cash flows. In the step 1, we shall put the cash flow here. The current cash flow is 52,094. 52,094 is the current cash flow. Now you have to calculate projected cash flow. Here you take this and multiply it by 10%. That is 1.10. You have to put it here. Okay. That is 57,303. It has come. Same, copy this formula for the entire cell here. It has come here. It has given the different figures altogether. Okay, we shall round it off all those things. We shall round it off to rupees crores. Okay. These figures have come. Now in the step 2, we will be finding out the PV. PV calculation we will be doing now. PV here. The present value calculation. Present value calculation of all this, we have to do it. Okay. Now you take the present value amount. Here the formula is already there. Present value PV is equal to FCF divided by 1 plus R over 100. 1 plus R. R is growth rate. Discounted rate is 12%. 1 plus that is 1.12. 1.12 to the power n. To the power n you have to put like this. Okay. Put the formula for the year 1. Year 1 FCF divided by 1.12 to the power 1 you have to put it. Okay, for the first year, that is 51,164 has come. 51,154 has come. Now you have to copy the formula for rest of the cells here. Okay, copy the formula for the rest of the cells. It has come here. You have to make small correction here. For the second year, you have to put here 2. Second year 2. Okay, and then for the third year it should be 3. For the fourth year it should be 4, and for the fifth year it should be 5. Like this you have to do it. It has come here. Now you make the total of all these things. Sum is sum 2,46,844 has come. Sum of all the discount to the present value. It has shown here. Okay, this is the amount. You have to note this one. Next we shall go to the step 3. Here TV we have to calculate. That is the terminal value. The terminal value you already put the formula here. Terminal value formula is already here. Terminal value formula is equal to FCF 5 into 1 plus G divided by R minus G. We will put the formula here. So formula is equal to FCF, that is 83,898. FCF 5 is 83,898 multiplied 1 plus G, 1 plus growth rate. 1 plus growth rate is 0.04, 1.04. Okay, you have to put it, growth rate is 1.04 divided by R minus G. R minus discount rate is 0.12 minus 0.04. Okay, this is the growth rate. Now press enter. It has come 1,10,90,673 is the amount. Okay. This is the terminal value you have calculated. Then convert this terminal value into present value. Here what you have to do is 10,673. You take this 10,673, divided by 1 plus R growth rate, that is discount rate 1.12. Okay, to the power 5. If you do this one, 6,18,877 it has come. Okay, 6,18,877 has come. This is the present value of the terminal value. Then in the step 4, what you have to do is calculation of intrinsic value. Intrinsic value you have to calculate here. Here you have to take that, you have to add both that whatever we got in step 2 and step 3. Step 2, this 2,46,844 plus this one 6,000, the present value of terminal value. Both you have to add it here. It has come to 8,65,721 rupees. This is the intrinsic value of the stock as on date. Okay, we have arrived at intrinsic value. Now in the step 5, intrinsic value per share you have to calculate. Per share here, for the per share, put the formula here. Go to the total intrinsic value divided by number of shares. Number of shares is 361.81. 361.81 is the per share. Is equal to 35 divided by 361.81. Per share amount has come 2,393 is the per share value of TCS. Now you can see that now the TCS trading at 21.25. So it is trading below its intrinsic value. So now based on this calculation and based on the advices from your financial advisor, you can buy, you can take your own decision about this stock. In this way you have to calculate the intrinsic value for any stock you are having. Section 5, the margin of safety. The most important rule, genuine professional gravity. This is the discipline that separates investors from the speculators. Here is the most important rule in this entire episode. Discounted cash flow gives you an estimate, not certainty. Small changes in your growth rate or discount rate assumption can swing the intrinsic value significantly. This is exactly why the professional investors never buy at the calculated intrinsic value. They demand a margin of safety, typically 25 to 30% below the calculated intrinsic value. If your DCF calculates intrinsic value of rupees 1000 per share, a 30% margin of safety means only you buy below 700 rupees. This buffer protects you from your own assumption errors and from unexpected business setbacks no model can predict. Margin of safety is what separates a calculation from a discipline. In section 6, where DCF works best and where it fails, we'll see. Sophisticated nuance prevents misuse of the tool and builds genuine credibility. DCF is a powerful tool, but it does not work equally well everywhere. Remember the 4 sector types from episode 19: cyclical, defensive, growth and rate sensitives. DCF works best for the defensive and growth sectors: FMCG, IT services, established pharma companies with a stable, predictable free cash flow. It works poorly for the cyclical sectors like metals and cement, where cash flows swing widely with the economic cycle, making any 10-year projection close to a guesswork. It does not apply well to the banks and NBFCs at all. They use a completely different valuation approach based on the book value, which you learned in short 33 PB ratio. Remember, garbage assumption in, garbage assumption valuation out. Use DCF as one important input among several, never as a single magic number. Now, the section 7, your action plan for today. Freedom number connection, bring it back to the live crash. And freedom number, the emotional and the intellectual close. Your action plan for today: step 1, pick one company from your episode 17 watch list. Step 2, open screener.in and locate or build its DCF calculation I have shown before. Step number 3, use conservative growth rate of 10% and a discount rate of 12%. Step number 4, compare the intrinsic value to the current market price. Step number 5, apply 30% margin of safety before deciding your buy zone. Remember Infosys yesterday, the price fell 608 Sensex point worth of sentiment in a single session. A DCF calculated on the underlying business would not have moved anywhere close to that much in one day. This gap between violent price move and a stable value is exactly where disciplined investors find an opportunity. And this number now feeds directly into your episode 20 freedom number journey. Buying below intrinsic value with a margin of safety is how you reach your freedom number faster and with a great safety. Comment below which company did you calculate? What is your intrinsic value versus the current market price? I reply every day, and follow episode 23 is coming next. Please subscribe, like, share and support. Thanks for watching.